Thank you for joining us on another edition of Mango Spaces. My name is Eric Mokai. I'm the founder of Mango Capital, where we try to have good conversation on markets. Today, we want to focus on the Kenyan macro, and our intention is to reflect a bit on Kenya's credit outlook, given the macro situation that is in the country. And with us to help us dissect this is David, who is from Moody's. I'll give him a chance to introduce himself, who he is and what he does at Moody's, and tell us a bit about Moody's itself.
Sure. Thanks, Eric. Hi, everyone. Thanks to Mongo Capital for the invitation. I'm David Rogovic. I'm a sovereign analyst at Moody's Ratings, focused on sub-Saharan Africa and other parts of the world. Today, I'll be here to share my sovereign credit perspective on Kenya, what's driving the current rating, the key risks we're watching, and what could shape the outlook. I've been the sovereign analyst for Kenya now for the better part of 5-6 years. And I have to say, before we start, it's always a pleasure and it's genuinely exciting to be here to talk about Kenya with Bongo Capital. This is the space that you guys have created, conversation that happens on X. It's some of the most engaged, insightful, passionate that I've come across when it comes to whether it's economics, policy, or financial markets. So really thrilled to be here.
Before we dig into your insights, maybe tell us a bit about your journey to becoming a credit analyst. How that been, and what's been your interest, especially in emerging markets, and how do you go about reflecting on emerging markets generally, and Kenya specifically?
I've been involved in emerging markets in different fields really for my entire career, almost 20 years now. I've been working at Moody's for almost 8 years and I've been covering Kenya for most of that time. Part of the reason why I like this venue is to talk about credit ratings, try to explain what credit rating measure, what rating agencies like Moody's, what we do. And maybe I'll take the opportunity now just to give a quick, brief explainer or background about what sovereign credit ratings actually are and what they aren't. First things first, a sovereign credit rating is an opinion on the government's capacity or on an issuer's capacity and its willingness to repay its debt on time and in full. Importantly, and this is something we stress to policymakers, to investors, to everybody, ratings are not a verdict on the country's economy, on its leadership, or on its future. It's merely a forward-looking assessment of credit risk. And ultimately, what ratings are meant to do, ratings are meant to help investors price risk, help allocate capital, and compare countries on a consistent scale. And this is one of the things I love about the job is that we spend our day thinking about sovereign, about credit risks, about how developments, whether it's social pressure, whether it's structural reforms, IMF programs, about how that will shape the future of a country. And that's something that's really special about the job.
When you're doing analysis, what are some of the factors that you're considering which go into your decision making towards giving a credit rating to a country? And then another question would be, is it true that the companies in a country cannot have a higher credit rating than the country itself? Is that factual or is that a speculative?
I'll answer that second question after the first. Every country really is unique, and there's special features or factors about the economy and about the structure that you need to take into consideration when thinking about credit risk at their credit rating. What we do at Moody's, and this is for transparency, this is to ensure consistency, is that we do have a framework or a methodology where we have specific factor scores, we have specific indicators that we look at, whether it's average real GDP growth over a certain period of time, the size of the economy, debt to GDP, so that when we do assign a rating and we do monitor a rating, the inputs are comparable so that at least as a starting point, we have this methodology that ensures consistency. And then there are a number of other checks and requirements we have in terms of the rating and the monitoring process that ensure that consistency. So having analysts from different regions who cover different countries involved in providing a peer comparison perspective, having a voting mechanism where it's not just myself as a lead analyst who's assigning the rating, but really a group of people come together to have an in-depth discussion and they have a vote at the end on the rating and the outlook. There are a number of steps involved in the process. Of course, it involves data, involves interactions with stakeholders, whether it's policymakers, whether it's banks in the country, whether it's the IMF, the World Bank. So we take into account all of that, ultimately applying it to a consistent methodology and framework to generate this final rating. Now, on your second question about companies and issuers within a country having a rating above the sovereign, it's generally difficult. We have something we call ceilings, which measure the risks, transfer and convertibility risks and stuff like that. But why issuers don't have ratings above the sovereign generally is because in the event that the sovereign is facing a severe crisis or seeing a severe decline in its credit quality, it's very likely that that's going to affect companies that generate the majority of their revenue in that country. And even when you think about the companies that earn foreign currency, if there's a risk that could be expropriated or that they have difficulty converting that or transferring that out of a country, that also weighs on the corporate rating. So in general, you don't see too many issuers rated above the sovereign unless they generate a significant share of the revenue outside the country and then there are checks in place or policies in place to ensure that they can service their debt. Because ultimately, it goes back to what ratings measure. It's the willingness and the ability of an issuer, whether it's a government, whether it's a corporation, a bank, to repay their debt. And if that ability is somehow impaired or impeded by a sovereign going through a crisis, for example, that affects its ability to repay that debt, and that would affect our overall assessment of its credit quality.
And especially on the first to iterate that there is a framework. And I think a lot of people assume that the assessment of country risk and credit ratings is more ad hoc. But I think it's good to emphasize that there is actually an actual framework that goes into and inputs that actually goes into the decision making to finally come up with a credit rating or a change in the credit rating. Is that correct?
That's exactly right. There's something we've had a methodology now for over a decade, more than that. And it's there to provide transparency. It's something that anybody can go on to the Moody's website or any web rating agency website, and you can see the methodology. It explains exactly how each of the inputs are used, how they combine with the other inputs to generate individual factor scores, things we call them factor scores, but basically variables that aggregate into measure of economies, countries' economic strength, or its institutional framework and its governance framework, or its fiscal strength. These are just words for the debt burden, debt affordability. But you see how all the inputs, all the data interact with each other to generate a final rating range, which guides our discussion. And the important thing is, I think maybe for listeners, is that it's the same methodology applied for any sovereign, whether you're the Solomon Islands or Suriname and you're a $3 billion economy, if you're Kenya and you're a $100 billion economy, or you're a G20 country and you're a multi-trillion-dollar economy, it's the same methodology, the same framework. And that's important because it helps to ensure that ratings are ordinal. So a country that's rated B3 or B2 has a lower risk of default than a country that's rated CAA1 or CAA2. And so it goes all the way on up to the highest end of the scale, but it's one scale for sovereigns at all stages of development, at all sizes, all different types of structure. And that framework in methodology is important to ensure that consistency and that the ratings ultimately are an accurate reflection of credit risk.
So perhaps you can take us through the chart of credit ratings that people can understand where Kenya is at in terms of rating before we dive into why it's rated there and your reflections on the recent visit in Kenya. So let's go through the chart a little bit if you have it in your mind or so. How does it go from the lowest rated to the top rated companies? So in terms of the bottom ratings to the top ratings.
It's a 21-point scale, and it's meant to be easy to identify and easy to understand so that if anybody sees it, they say, okay, I know what a AAA rating is. But at the top end, at the highest end is a AAA rating. And from there, we go on down to C. The C rating is the lowest. It usually indicates a sovereign either is in default, or if it's not in default, we expect it to be imminently in default and for losses to be very high for investors. So the scale goes from AAA. The second highest level is AA1, goes AA2, AA3. So we use triple, going from A down to AA, single A, B, AA, BA, and so on down to C. And then we use numbers 1, 2, and 3 to separate or to distinguish within each alpha score. So AA1 is higher than AA2, AA2 is higher than AA3. When you get to Baa3, about the midpoint of the scale, anything above that or rated higher than that is investment grade, or what people refer to as investment grade. And anything below that is what most people would refer to as non-investment grade, speculative grade. There are different words people use, but we call it non-investment grade. And the probability of default when you go down that rating scale from AAA, which is also very minimal risk of default, especially over a 1, 2, 3 year time horizon, even in the BAA, so all investment grade category, very low risk of default. Even at the high end of the non-investment grade category, BA down to B1, B2, B3, the risk of default is very low. The probability of default and based on historical evidence, the historical default rate over a 1 year time period, for example, is less than 10%, less than 5%, maybe slightly above 5% at B3. Kenya is rated CAA1 at the lower end of the scale, which signals there are credit risks and it is susceptible or vulnerable to shocks. But let me just say what a CAA1 rating is and isn't, just to help distinguish slightly. We typically look at ratings and the probability of default over a multi-year time period. So if we have a rating that's CAA1, it doesn't mean we think a default is imminent. If we downgrade a country like we did Kenya in 2024 from B3 to CAA1, it doesn't mean that we think they're going to default tomorrow or in a month or a week or a year's time. At CAA1, it's still a relatively low probability of default within a 1 year time horizon, although that increases as you get further down, so from 3 to 5 years. But again, CAA1 is a rating level, which I would say indicates that there are structural weaknesses in the credit profile. That means the rating or the issuer is susceptible to shocks. And if there were a multitude of shocks or a large shock to hit at this point, it could push it lower into the rating scale. And when you move below that, you are talking about countries in most cases either that are very fragile or we think there's a high likelihood of default in, let's say, a 1 to 3 year time horizon.
And why is risk of default something that you consider, probability of default, in terms of a country or an organization? How does that factor into your credit ratings usually?
That's exactly what our ratings measure. We measure probability of default, and then when we think the default is imminent or very likely, then our ratings also capture to the extent that we have an assessment on the size of the losses. So when you see sovereigns going through restructurings, we're looking at ultimately the losses that are borne by private investors. So it's not the World Bank, it's not an official loan or bilateral loan from a government to government, but the losses that are imposed on Eurobond holders, on private banks, any private creditor. And so the ratings ultimately are measuring that probability of default and that risk, the expected losses associated with that default when the probability is close to 1.
And then for a layman, how should they think about credit ratings in regards to perhaps their personal loans? If you could maybe parallel the two so someone is able to understand the credit rating to a country, now that parallels perhaps to a bank's rating on a person when they're giving a loan. Is that something that you would consider maybe an analogy for?
Yeah, if you think about you have a credit score in some countries and that signals an assessment of your ability to repay loans. And that's what banks are going to use to measure the risk of lending to you. And that may then affect the interest rate they charge on your loan. If it's a mortgage, their willingness to even extend loans to you as an individual, as a business or as a household. And ratings can have a similar purpose. It's our opinion of that risk of default. And it's something that we aren't comparing. We have different methodologies for different types of corporations. So we're not using the same methodology, same indicators to measure ratings for every asset class. So if we're looking at structured finance or at bank ratings are different than sovereign ratings, we have different indicators we use. But ultimately, they should have a similar sort of probability of default or historical default rates at each rating level. So they should be comparable. So I think it's an apt analogy.
We can go back now to your recent visit in Kenya. A lot of people seem to think that a lot of these credit rating agencies do their work based in New York and from their readings and assessments. You could think of it more of an airplane's view of the country. But then again, you do come to the country pretty regularly to kind of sit down with authorities and with investors in the private space to be able to discuss and discern some insights from them that you're able to factor into your modeling. So perhaps you can discuss your thinking about the travels, what you learned, especially from your recent travels in Kenya. You can share a bit of the insights that you gathered.
Sure. We take information wherever we can get it from, whether we're behind a desk in an office or when we go in country and on the ground. Obviously now with the way technology has changed, even from a few years ago, people are much more comfortable going on a Zoom call now than they were in 2019. And whether that's the government, whether that's investors, local IMF reps, stuff like that. So it makes that job easier, but there is something you get from being on the ground and from building up context over time. So just the background on where we are at the rate. So we're at CAA1 on Kenya's rating. That's come down since we assigned it in 2012 from initially B1. So it's been a steady decline in credit quality in our view. And that's mainly, you can look at it in different factors, but essentially there's been a very rapid buildup in debt. More than debt, it's been a very rapid increase in the interest to revenue ratio, which is how we measure debt affordability. Historically, it's been a better predictor of future defaults than even debt to GDP ratios. And we've seen in Kenya's case, it's around 33% interest to revenue. That's, I think, the sixth highest of the 143 sovereigns we rate globally. It indicates a very weak interest to revenue ratio, very weak debt affordability. That's been behind the historical sort of trend down in the rating. And then tied to that is liquidity risk. We did assign or change the outlook to positive in January of this year. So We were on negative, went to positive, because at the CAA1 rating level, which admittedly, again, is a very low rating, we saw signs that things were not just stabilizing, but improving. That would lead to a stabilization in debt and improvement in debt affordability. So let me explain that a bit more. In January of this year, so just about 6-7 months ago, we were looking at the trends in terms of borrowing costs for the government, where they're borrowing in the local market, T-bills and longer dated bonds. And we had expected, obviously, with the beginning of an easing cycle, that borrowing costs would come down. But we were seeing strong demand, strong appetite at bond auctions. Borrowing costs were coming down. We predicted further declines in borrowing costs. And we thought, okay, if the government can meet its fiscal targets, and at that time, their target for the fiscal deficit was 4.3% of GDP for this year, the one that just closed out. We thought if they can get close to that target, and we didn't think that was realistic, we thought it was something closer to 5. It turned out to be larger than 5% or higher than 5% of GDP. With that decline in the fiscal deficit and decline in borrowing costs, we saw the potential for debt to stabilize and, importantly, for debt affordability to stabilize. At the same time, the risks that we saw over the upcoming maturities, which are still quite large, we saw some improvement there. The first one being the exchange rate. Obviously, anybody in Kenya knows how stable it's been, but we saw the central bank accumulating reserves, not just from disbursements of loans from the World Bank and the IMF late in 2024, but actually buying dollars in the market, bringing reserves up to just under $11 billion recently. That's a big war chest of reserves to have that gives you a bit more breathing room. At the same time, I said we saw reserves increasing, we saw the exchange rate stabilized, the current account improving. So we saw improvements on the external front, plus a Eurobond issuance in February of this year, the UAE loan, signaling, again, the government has access to somewhat diversified sources of funding. So we thought in this scenario, with interest rates declining, access to external funding, larger stock of reserves, if the fiscal were on course to meet that original target, that there was a potential path back to a B3 rating level, which would be one notch higher than we are today. The biggest difference between January and now, I think, is the fiscal, where there was some optimism over some of the tax measures, the tax amendments late in 2024, that they would help the government recover some of the underperformance on the revenue side in the first half of the fiscal year. We didn't see that in the second half of the year. We saw some more spending pressure. And now we've seen a shift, I think, in terms of the government thinking about the fiscal and acknowledging, I think, some of the social and political realities that they can't pursue a revenue or tax-led fiscal consolidation, but need to take a more gradual approach. And so now we are forecasting slightly larger fiscal deficits. But again, even with that, there is still a path to a higher rating level. There's also a path to a stabilization at the current level.
One key takeaway, at least from my visit, has been that the macro looks good, but then the micro, in terms of how the impact on Kenyans has not been very good. Is that something that you noticed in your recent visits?
Yeah, I'd say every time I've been going to Kenya now for almost just about 10 years. And I remember the first time I came back to Kenya after the pandemic, so it was 2022. It was just after the election. It was the most positive I had seen Kenyans, really businesses excited for a new administration, really eager, expecting the business community to thrive. Since then, each time I come back, it's been a bit more downbeat. This last time, I think probably the most negative in terms of the macro, in terms of you see this in some of the numbers, in the employment, in the wages. I think it's a buildup of a number of issues, but if you just look at real wage growth, how much is the average person earning today in real terms relative to just for inflation versus 4 years ago? It's been declining for 4 years in a row. The unemployment rate is low. Again, economic prospects, people are not as optimistic. So it's weighing on sentiment a little bit. We see that in the credit growth numbers. We're still expecting a decent growth rate of close to maybe slightly below 5% for this year. But definitely the way you described it, the disconnect between some improvements at the macro level versus at the micro level, the challenges that people are facing, you definitely get that sense that there is that struggle and that is that disconnect between the micro and maybe some of the positive on the macro side.
Is that something that factors into your decision making at all, or are you more focused on the macro aspect of it?
It affects the macro aspect to the extent that it affects the sustainability of the policies, right? So I think that the best when you look at last year, so you had this tax policy, or the government's plan was to pursue this very heavy tax-led fiscal adjustment that ultimately they turned away from, because it wasn't sustainable in that environment. And so the micro level, to the extent that it affects the ability of the policy makers and their decision making and their policies to deliver, it has an impact. I think last year's a good example. Even this year, when you look at the tax measures, why they aren't having the intended results or intended effect is partly because of the slowdown in the economy. And when you look at the structure of taxes and how much of the burden has been placed on formal employment, I think there's a recognition that there's only so much you can tax the formal sector, which is quite small. It's 3 million employees in the formal sector in terms of the labor market. The micro matters to the extent that how it affects policy choices and policy effectiveness.
And then in terms of something that Kenyans have been crying about is a bit of maybe the government to cut back on expenses. That means austerity, so to speak. If the government were to go that route of implementing austerity, how does that usually factor into credit ratings? Is that something viewed positively or negatively?
Not necessarily either or. I think in Kenya's case, when you look at the adjustment they've made so far, we did think that there needed to be an element on the revenue side because tax revenue is more stable, more consistent, and there appear to be areas where there are large exemptions that you could remove and you could adjust, and it would provide a reliable, steady source of revenue year after year. Whereas typically, and this is the case in Kenya as well, when you look at the original budget in any given year, and when revenues underperform, for instance, what does the government do? They go and they cut back on development spending. Now, you can say if that's a reduction in spending, that's fiscal consolidation. On the other hand, it's not necessarily as sustainable. Okay, you can cut back on spending for 1 year. You can delay spending on operations and maintenance, buying a new fleet of cars, making office repairs, right? For a year, for 2 years. But eventually, you need to make those repairs and then that money needs to be spent. On top of that, you have the issue of pending bills that are not incorporated in the fiscal projection. So there, in our view, an expenditure-led adjustment faces more challenges in terms of the sustainability, not just for 1 year, but again, if we think about projections, where will the fiscal deficit be in 3 years' time, in 4 years' time, and then the implications for the debt burden, it's a lot easier to see 1 year where you can cut back on spending. But from these levels, without a major structural change in the spending structure, which is hard to envision, I don't think you can keep spending at this level consistently because development spending is down to 3.5% of GDP. Historically, it's been higher than that. That's one area where there is an infrastructure gap. There are needs there, the housing, different areas of the economy, energy sector, that there needs to be investment and development capital allocated to these sectors. And so without that, we think then you have an impact on growth. And then with the impact on growth, you'd have lower revenue. So ultimately, there needs to be a balance and what's sustainable. Right now, it seems to be much more heavily focused on the expenditure side, but there is still this medium-term revenue strategy. There are still some areas where you could see some improvements in tax collection that could help balance that out. But it's not an either or. In this case, I think there's an element that the spending side is more difficult to implement. And again, if you look at the historical data, and we look at this very carefully, we look at the budgeting, at the budget numbers in the beginning of the year versus the outturn for that year. And on the revenue side, most years, I think the average going back to 2015 or something, or back to 2016, I think what we did, the average shortfall is about 7 or 8% in total revenue. Ordinary revenue, which is what I think a lot of Kenyans think about, also about 7% below the budget year. So what the government projects at the start of the year versus what they actually collect. On the spending side, you look at recurrent spending, it's been just about in line. And development spending, they've cut back every year on average about 20% relative to the original target. And the challenge is that in 2015, your interest expense was much smaller than it is now. So you have less room to really reduce spending as what goes under the consolidated fund, the interest, the pension, the county transfers are all, they need to be made. You have much less room on the expenditure side to cut back in the event of a revenue shortfall.
When you look at perhaps the development spending versus the other side of the spending, does that worry you in the sense of that the government is cutting down on development spending by 20% on average? Is that good for a country long term when you do look at that versus the discretionary side?
You have more discretion on development spending than you do, especially on the domestically financed portion. So there's a portion that's financed externally from loans from the World Bank, from AFDB, from others, right? And if you cut back on those projects while you're reducing your funding, there's no net benefit in terms of your fiscal deficit versus your financing sources. The area you do have discretion over is your domestically financed development spending. Natural area where you would cut back on, you can look at it in different ways. I think given the infrastructure shortfalls, I think there historically has been higher development spending. When you think about the impact that has on the economy, the feeding through to liquidity in the banking system, to spending in the private sector, it has an impact in terms of being contractionary. If you can make development spending more efficient, if you can leverage PPPs more, that could lead to a situation where development spending can be lower and you still are achieving gains in terms of the quality of infrastructure. So it's not an absolute number that has to be 5% of GDP, but without an improvement in the efficiency or without an increase in private investment, it's hard to see how this is maintained indefinitely.
And then looking back at last year, the government had some ambitious plans through the Finance Bill 2024, and they were shot back by public dissent and discontent over the revenue-raising measures. How does political risk and public discontent factor into your decision-making in terms of credit ratings generally and your view on a country?
In every case, the way we look at it is on the impact that it would have on policymaking and what does that do to the government's range of policy options to address the current situation and future shocks. At the time, in July of last year, in August, we had concerns over how the new government, the new coalition would function, the ability of the government to get back on track with the IMF program, or how quickly that would happen, how quickly the market access would return. And in the absence of all that, an increased reliance on domestic financing. In this case, what we've seen is, yes, it was a major shock to the country and there was an adjustment relative to their plans. But since then, the government has been able to carry on with its plan. They've definitely adjusted the approach in terms of tax measures, but it's been effective in terms of policy making. We saw these tax amendments last year. It hasn't prevented legislation from going through Parliament. We've seen progress there in different areas. So I'd say that looking back today versus a year ago or 2 years ago, I don't know that the policy environment, that the political environment is having a significantly more negative impact today than it has in the past, at least in terms of how the government operates, in terms of how budgets are passed. There has always been these frictions, this tension between what's proposed in the budget and what's actually ultimately passed by National Assembly. You're seeing that today as well. But it's no different than it was a year or two ago. I think where there is a difference is on the range of policy options that are available to the government. And that's where I think there's much less appetite or much less scope to imagine where the government would put forward a new tax proposal similar to last year. So that would be the main difference, is the range of policy options and what that means for a country like Kenya, for a government like Kenya with the rating where it is, and its debt structure, its debt burden, is that in the event of a shock, it definitely limits the scope for the recovery from that shock and the reversal of a temporary rise in debt, because they don't have the same policy levers that they would if it were a different sort of political or social environment.
You can see that in the Finance Bill 2025, at least they were not able to raise as much as they wanted to last year. So that scaling back of options is definitely a factor. Perhaps one more thing that Kenyans are really concerned about, and I think you met with one of the key people who is behind the discussion around debt in the country, especially the bit that they call odious debt. I think the uptake of debt, which they don't consider, was actually taken up by the country and the country should not repay. What was your key takeaways from that discussion and your general view on perspective, especially on debt and sustainability in Kenya?
On the issue of odious debt, I won't say much on that. I think Kenya is a very litigious society. I don't know the number of lawyers in Kenya, probably would be the number 2 behind economists. I'm just joking. It's a very litigious society. Everything goes to the courts. And I think that's how I would describe this issue on the odious debt. Now, I'm not a legal expert, so I can't comment on the constitutionality in that, but I think there would be a court process to do that. But I think it does speak to a different issue, which is the framing of elections, the social pressure, the social unrest that we saw last year, and now you haven't seen economic issues become as much of a policy or much of a topic in terms of election cycles as you have more recently in Kenya. And I think that's where the issue of debt and the spending, what is money being spent on, why are taxes being raised, or what are tax dollars being spent on, what's the efficiency of the spending, is it being wasted on, or is it being funneled away through corruption, how is it being used? That's becoming more of an issue. And I said to start that whenever I come on Mongo's capital spaces or Fiscal Kenya, these are some of the most informed people that I meet with and that I hear from. And that's the key point, is that I think the issues over debt are becoming more of a front and center issue in terms of politics. How it will affect the elections, I don't know, but it's an issue that's affecting people's everyday lives. It seems like it's going to have more of an impact on elections or how different parties prepare for elections.
Yes, and is Kenya's debt currently sustainable from your perspective and your framework?
Yeah, look, this was last year, the fiscal year that just closed. Our estimate of debt is that it was at 66% of GDP or 6.5% of GDP. This would be the first sign. If I look back, the year before was 68%. The year before that, 71.7%. This is the first 3-year period. I can go back to the start of the prior decade where debt has actually been stable or even coming down marginally. Debt at 65% of GDP is not incredibly high. When we look at ratings, it's about in line with the median for C rated and B rated sovereigns. I don't know what the debt, and even for our forecast for the fiscal deficit, we're forecasting around 5%, slightly 5.2% for this year, 5.2 for next year, but roughly 5% fiscal deficits. For a country that's growing at 10% in nominal terms, with debt at 66% of GDP, you could have a fiscal deficit of 6.6% and stabilize debt, assuming the exchange rate stays stable. From like a purely mechanical equation, debt is sustainable and debt should come down. We have it coming down by about half a percentage point per year. Now, that assumes a fairly stable exchange rate. But again, on the FX side, I don't see anything that points to an overvalued. If anything, the pressure is the other way from the pace of accumulation of reserves and central bank buying. The issue, again, goes back to debt affordability. And I said at the start that interest to revenue ratio is at 33%, the sixth highest of all our sovereigns that we rate. That doesn't come down, even with the debt level coming down a little bit this year, next year. It stays at 33%, it comes down a little bit more in 2028, 2029. And this goes to why maybe debt is sustainable, but why a 5% fiscal deficit is a challenge. And it's because if you look at Kenya's debt maturity profile, they have about $3 billion per year in external repayments, approximately, if you just look at average next 5 years. So let's call that 3% of GDP, a little bit less than that, 3% of GDP, 2% of GDP. When you look at 5% fiscal deficit, where are you going to find part of that is being financed externally, let's say. From where do you find the external financing? Is it the World Bank? The IMF doesn't have much room to lend. Is it the UAE? It's Eurobond market access likely, or some portion of that's going to come from the Eurobond market. So you're talking about $4 billion roughly in terms of dollars you need to borrow per year just to repay your debt, pay your interest, and finance a small portion of your fiscal deficit. And the rest has to be financed domestically. And there you're borrowing at, in the good case, 12%, 13%, slightly higher now. That is the challenge. And that goes to that debt affordability issue. And that goes then to the spending flexibility. You have the room to increase spending if you need to respond to a weather-related shock, for instance, or election-related spending, or to clear the stock of pending bills. And so the issue is really on the funding structure, on ensuring access to a diverse set of both domestic and external financing. Again, not just for 1 year, but if you say that the deficit will stay where it is at 5% or 5.2%, and that financing breakdown of 20% external and 80% domestic is going to stay in place, it's hard to see debt affordability improving. It's really hard to see a significant improvement in Kenya's debt affordability.
You paint a very grim picture of the future, I think, in terms of debts. I think if you need $4 billion per year, like to be able to sustain the debt payments plus the interest rates, that's pretty bleak, I would say. What would be your opinion there, generally?
That goes back to the idea of what ratings are measuring. It's our assessment, not necessarily of, okay, what sources of funding will come in, but we can look historically at who has provided the majority of funding, right? We don't see, pre-pandemic, it was China Exim Eurobond access every year, consistent Eurobond market access. Then from 2020 to until 2024, it was the multilaterals. Now looking forward, we have very little visibility, and it's hard to reliably count on bilateral funding from Chinese creditors, from the Middle East, from syndicated loans, right? So multilateral World Bank funding is available. It's part of our assumption for this year, but it does require reforms, right? And it does require policy actions. And to the extent the government takes those, that should unlock that funding. IMF funding, again, from a fiscal financing perspective, there's not that much available, I don't think, under normal access, especially. So it leaves you in a situation where you need to rely on access to Eurobonds to refinance or to buy back maturing debt or existing debt to improve the maturity profile. Can't rely on funding from bilateral creditors like the UAE loan. So it's possible, again, it goes back to the fiscal. If there's a credible fiscal story that the fiscal deficit's coming down will be sustainably, let's say, below 5% of GDP, the debt will come down by a percentage point per year, that domestic financing conditions are going to remain how they are now or improve from here, it's a much more positive story. And with that story, then you have access to Eurobond funding, to other access to syndicated loans at lower costs, to World Bank funding, to guarantees, to sustainability-linked bonds, right? It improves the access to different sources of funding, which then improves your debt affordability. And that then leads to further, that can engender a positive or virtuous circle where that leads to a fall in interest costs, and that leads to creates more space to increase spending on development, on education, on whatever area. I can see two scenarios. One is, like you said, maybe more grim, one's more positive. And I think in both cases, it comes down to the ability to deliver on a fiscal consolidation.
And then in the terms of market access for emerging markets and for African markets generally, I know early in the year, a few sovereigns were able to go to market and be able to issue a few Euro bonds. I think it was quite a good start to the year. How does the market look like for most sovereigns heading into the second half of the year, especially Kenya?
I don't think we've seen the issuer from Sub-Saharan Africa issues since Liberation Day, when the U.S. announced the tariffs in early April. We have seen access for a number of other emerging frontier markets in Europe and Latin America. I don't think the market conditions are as bad as they were in 2022 after the Russia-Ukraine war started. Right now, looking at yields, there's a lot of uncertainty over the direction of the Fed and monetary policy. Uncertainty, I think, still over ultimately what this new tariff regime means for different sovereigns. But in that case, Sub-Saharan Africa doesn't seem to be the most affected region because of they're less integrated globally in terms of trade. There's not as much urgency to access markets for a country like Kenya right now. So again, they have time, and that buildup in reserves too is important there because they do have repayments this year. The Exim Bank loan comes due in mid-July. Then the second half of the calendar year, you have some syndicated loans maturing. So it does create some pressure on reserves without new funding coming in. But I think there's the World Bank funding that I mentioned before. That's possible. The IFPs, there still seems to be foreign interest there. So that's a source of dollars that can come into the government. I don't think there's any urgency right now, but that's for a 6-month period, for a 1-year period. I think a year or 2 years, you need to have, Kenya's a country where I always said they need to have reliable market access given its debt structure, given the amount of debt that it has coming due. They can go through periods without market access, but they will need to be a consistent sort of regular market presence or have a regular market presence.
I wanted to discuss a bit about the perspective that a lot of African sovereigns are having on rating agencies. I think they view them as being negative, at least being too negative in the African environment, which hinders market access to a lot of the sovereigns and the companies in there. So there's been a bit of pushback from the African countries generally, and I think from the AU, and who want to have their own kind of rating agency. What's your take on that generally? Are you guys a bit too negative in the African story?
No, it's a criticism or a comment that we hear often, and we try to address it. First off, say we don't look at a sovereign rating and say, okay, we don't have a lot of information, so let's just be more conservative or negative and not lower the rating or something like that. If there's not enough information to rate a sovereign, to rate a credit, we won't rate them. We've withdrawn ratings in the past because of lack of data, and we say we just don't have enough information to assign a rating. So if we have the information, we use it. We don't take a conservative stance because we don't know something. If we don't know something and we can't rate it, we say that. The other thing is we do measure our performance in terms of ratings, and are they a good predictor of default? So is a sovereign that's rated higher historically, are they less likely to default than lower? And we looked at this data across ratings and regions, right? So you'd expect to see countries that are rated B1 have a lower historical default rate than sovereigns rated B2, and B2 sovereigns have a lower default rate than B3, and so on. And we looked at that for Africa, and we looked at that for all regions, all sovereigns globally. And we went back in time, we looked at this, and admittedly, there aren't a lot of defaults, but from our estimates, they were statistically significant. And there was no difference in default rates for an African sovereign or a sovereign outside of Africa at B1, B2, B3 rating level. So the rating level that we looked at, there was statistically no difference. In fact, there was actually a slightly higher default rate for African sovereigns and non-sovereigns outside of Africa at each rating level, indicating that default was actually a little bit higher than the outside of region comparisons. To the extent that our historical ratings have proved accurate, and ultimately that's what investors value, this assessment, this analysis that we did would indicate that the ratings are appropriate, and that if there's a difference in terms of the cost of capital or cost of funding, it's not from a ratings perspective, but there's another, it could be from an investment perspective or somewhere else. But I don't think the ratings are misaligned. It's something that we look at and we care about. We have every incentive to avoid that bias, but we try to back it up and we try to ensure that our ratings are accurate. We do have measures, ways to assess our performance in terms of ratings accuracy. I just described one of them that I hope dispels some of those comments about the negative bias.
Final question to you. So in terms of looking forward in the Kenyan credit outlook story, what are some of the key things that you're watching out for, perhaps including elections and how they may impact your thinking around Kenya's credit rating going forward? So what are some of the key variables that you're keeping an eye on going into 2026, 2027 elections also?
So when we think about what can move the rating up and we have a positive outlook, we're looking at domestic financing conditions. Do they continue to improve? And we're looking at signs that fiscal consolidation or that the government will deliver on fiscal objectives for this year, even delivering on deficit target for the year that just started. That would be an improvement from the previous year. Essentially, all this boils down to how we assess liquidity risk and what that does for debt affordability. So things we're looking at are domestic borrowing costs, size of domestic funding or domestic borrowing, the size of the fiscal deficit, which is tied to the domestic funding, ultimately the impact that has on debt affordability and how that affects our debt trajectory. To the extent that one or all of these are moving in a positive direction, that could help move the rating up. The same on the external side, where we monitor reserves and what that reserves look like in terms of adequacy relative to upcoming debt payments. Now, what would move the rating down or what would stabilize the rating here? Similarly, if we saw financing conditions fail to improve or reverse, that could result in elevated liquidity risk and weaker debt affordability, or mean that debt affordability is unlikely to improve in the future. All of this would be, I think, more consistent with a CAA1 rating, a stable outlook. This could be because we see higher borrowing costs or a weaker commitment to fiscal consolidation, leading to wider deficits and debt metrics that are weaker than we're expecting. So I don't need to touch on the elections cycle, but the elections would fit in here, what that does to the fiscal, to external financing, to domestic financing, and ultimately how that affects the metrics that feed into our ratings assessment, to our methodology, and to our scorecard.
Parting shots?
No, just again, Eric, I appreciate you guys giving me the time and the platform. I always really valued interactions with Mongo Capital and the Kenyans on Twitter or on X. Looking forward to our next conversation in the future.
All right, David. Always a pleasure hosting you. Looking forward to more of your work. So those who don't know you, you're actually behind the credit ratings for Kenya. So they should read all of your work that you put out. More than just the headline ratings, there's always a lot of content and the research that goes behind it. So I should say I appreciate what you do. And I do read a lot of the works that you put out. We try to make it our aim and our goal to make sure that as much information is shared to the audience as possible. So always keep it on our timeline, dear listeners, so we're able to get access to such. So David, thank you so much for your time, and I hope that you continue informing us and keeping us updated on what's happening.
Great. Thank you.